Good space time, y'all. In this episode of the Citizen Cosmos podcast, I speak with Riley Edmund, the co-founder of Stride, a liquid staking provider chain on Cosmos. Amongst other things, we discussed what is liquid staking, IBC, tokenomics, choosing validators, sustainable business models, what to do and what not to do when launching a blockchain project, sleeping in the office, and Berkeley.
If you were to spin up a validator with 100% commission and vote your share of the weight up very high, you've essentially attacked the network. And now all the other validators have much less stake, and the Nakamoto coefficient is actually much lower, and all the commission goes to you.
Let's say that the Stride is held by only a selected few whales, and those whales keep on voting on a specific validator to increase his weight in the liquid stake. I don't know why they would do it. It would be a crazy situation to get the puzzle together.
I think you're really starting to see a shift towards distributed app-specific chains that have control over the full layer of the stack.
But before that, well, I guess Berkeley and blockchain kind of go together already in my head.
They're the same thing now.
Yes, it's like Berkeley blockchain, bam, even with the same letter, right, BB? Before we rocket off into the podcast, here are the latest news from the sponsor of this episode, Cyber. The Cyber Congress DAO has opened the portal, and Atom, ETH, Terra, and Osmo users that meet the requirements can claim their gift and their moon citizenship on SIB.ai. Hey, everybody. Welcome to a new episode of Citizen Cosmos podcast. I have with me Riley Edmund today, the co-founder of Stride Labs. It's a liquid staking blockchains, app-specific blockchain. Wow, I got confused, people. I don't know what's going on today. I'm going to introduce Riley again. Riley, man. Riley is the co-founder of Stride Labs. There's a blockchain, Stride, with liquid staking, the first liquid staking blockchain on Cosmos. Riley, man, welcome to the show. I'm sorry, I got it all wrong. I got it confused. It happens.
It's very confusing. I don't blame you. I've confused it myself, to be honest. It's great to be here. Thanks for having me on. I'm excited to talk about liquid staking.
First of all, please correct me. Stride Labs, that's the entity behind Stride, the blockchain, right?
Yeah, so Stride Labs is a team of contributors who written some code that goes onto the Stride blockchain. The Stride blockchain is a product, app, blockchain in the Cosmos ecosystem that allows you to liquid stake their tokens across any IBC-compatible chain.
Nice.
And then there are a bunch of things under the hood, but from the point of view of someone who wants to use Stride, it allows you to liquefy your tokens.
And the first blockchain it's connected to, it's Atom, right?
Yes.
Right. That's the one I tested 2 days ago. Woo!
Ooh, I hope it worked.
It did, and it was very, very, very cool experience, very quick. Well, there was some waiting of the confirmation of the transactions, of course, but I guess consensus first and everything else later. But the one thing I will ask you about the ledger compatibility, man. When is that going to be on?
Ledger is coming very soon. So we're in touch with the Ledger team, the Kepler team, and a few others. It's a priority for us. And in fact, many other teams in Cosmos are using a slightly older version of Kepler. We decided to upgrade to the new version. And with that come a few growing pains, including Ledger support. It's not compatible with this version. So we're actually trying to roll that out right now with those teams.
Nice. I know it's not easy because I know when I've worked closely with several teams already, and it's always a huge pain in the ass to get Ledger working with something specific. It's like,
yeah.
So good luck on that.
Yeah, thanks. Ledger is compatible already with Osmosis, of course. So if you want to stake your item right now, you can trade into the Statum pool. This is one of the magical parts about liquid staking. You don't have to use the product to liquid stake. You can go to the pool on Osmosis, trade it into ST Atom, and as soon as you're holding it, you start accruing rewards as if you were staked. It's identical.
Nice.
So if you have Ledger today and you want to liquid stake with Stride, go to the pool, trade in, same exact thing on the back end. And then in a few days, we'll have it live on the side as well.
Thanks for saying that, because it's one of those obvious things. Until you hear it doesn't click in your head, and it's obvious. If you're already exposed to ST Atom, which you are via the pool, obviously you have ST Atom, then you can go swap them. But sometimes it doesn't click, so thank you for saying that.
It's unintuitive. Until now, everyone has always staked through Kepler, or you go to the command line, you stake there. I don't know how many users are doing that. Or you go through some other interface and you click stake, you get your shares back for staking, but you can finally do it through a DEX.
I do have a question for you. I love that this episode started from me complaining. This usually doesn't happen, but let's carry on.
We want to hear all that.
No. It was just like a really curious question, which I'm sure you probably got asked before. And there is a small section in the FAQ about it in the documentation as well. But I want to ask you that, and I want to hear a bit more of an explanation. And of course, you can give me one. So when I staked Atom, the first question that goes to my head: who is this Atom staked with? And how do I choose the validator that I want to stake with? Tell me all about it. How does it work and everything that's underneath?
Yeah, that's a great question. So the goal we started with when thinking about validator choice was this idea of Nakamoto coefficient. And I'm sure you've heard of this term. It's been thrown around Twitter all the time. But the simple idea is that some number of validators will control 1/3 of the stake. And if they collude, they can stop the network from producing blocks, halt the networks. Nothing will happen from that point forward. And you look across Cosmos, these numbers are anywhere from 4 in really low case up to, I think, 12, maybe even 20 somewhere. But it tends to be between 6 and 8 or 9. And one of our goals with Stride is to increase the Nakamoto coefficient. And that's the core goal with validator selection for Stride. So we designed everything around that. Now, we looked at a few models for how various liquid staking providers have approached this problem. And on one hand, you have entities like Lido on Ethereum who choose to have a whitelist. So they choose which validators are in the set. And anytime you come to Lido, you give them your ETH. On the back end, they stake it across validators who are in the whitelist, and they give you back your voucher, the STETH. On the other end of the spectrum, you have approaches like Intense, where the validator set is unlimited. Any validator can be included, and users get to choose. But the mechanism by which validators are chosen is not super well defined yet. And from a security perspective, we're not sure how it's possible to implement something like that in a way that's safe. A very simple example of an attack that one could levy on Intense is when you liquid stake, you choose which validator you'd like to your stake tokens to be delegated with, and then you sell and you repeat. You can do this in such a way that if you were to spin up a validator with 100% commission and vote your share of the weight up very high, you've essentially attacked the network. And now all the other validators have much less stake, and the Nakamoto coefficient is actually much lower, and all the commission goes to you. So this is kind of a fundamental problem with intense-based models. That's the spectrum. Then there are a few players who are kind of in the middle. So Marinade Finance on Solana is a good example. Their approach to validator selection is data-driven. So they have a very clear algorithm by which they choose validators who are going to be included in the set. For example, validators with high uptime, with geographic diversification, with hardware diversification. For example, it's possible that there is a consensus bug or a hardware bug in one type of hardware. And for that reason, you'd like to have different types of hardware. Or you don't want all your cloud providers to be in Hetzner, as we've seen in Cosmos. If they shut it down, you're in trouble. So you want to diversify across those. Also have some on-prem servers or bare metal validators. So that's just some context for the problem that we mapped out when we first got into this. And the decision we ultimately ended up going with is you have Lido, you have Intense, and you have Marinade. We're very, very close to the Intense end of the spectrum, where any validator can be included. The token holders decide which validator gets the stake by voting, but we do it through governance rather than through Intense because we think it's much safer, yet equally decentralized.
So for now, does that mean there is only some selected validators included already?
Yeah.
Okay, and those are listed, I think, in the FAQ, right? If I'm not mistaken.
I don't think we've listed the validators in the FAQ. We have a set that we decided that was minimally opinionated. We just chose the validators that are already in Cosmos. And now users can vote, token holders of Stride can vote to increase the weight of any validator. So it's completely up to governance. We started with a minimally opinionated set, which was just the voting power weighted set on Cosmos. So if you go liquid stake today, that's where your tokens will go. But users could vote anytime they'd like to alter that set. And in fact, we're working with Cyborg, who's putting out a validator ranking system, working with him to expose a lot of the data around validator ecosystem contributions, validator uptime, validator time to update. That's an important metric as well, as we've seen with a lot of kind of botched updates around the ecosystem. We're going to expose those metrics so that users can make informed choices when they vote. Because right now, frankly, a lot of it is kind of blind.
I have a strange question because technically, from what I'm hearing, if the users, the token holders of Stride, can vote to increase or decrease the share of any validator via on-chain voting. So let's say, for example, let's pick a crazy situation. Voters of Stride decide that the bottom validator on the Cosmos set should technically be receiving the biggest. That's possible, right? That scenario. But what if could you socially game this in a way that the Stride governance would be voting only for the validators that are bringing, let's say, value to the Stride ecosystem? I guess you're not gaming that, right? I guess that's kind of just like the rules of free market. But do you see what I'm getting at? The question is like, could it be, let's say that the Stride is held by only a selected few whales, and those whales keep on voting on a specific validator to increase his weight in the liquid stake? I don't know why would they would do it. It would be a crazy situation to get that all the puzzle together. But I don't know if you know that question there. It's kind of something that comes to mind though.
Yeah, it's a good question. I think this is something that a lot of DeFi protocols who operate through governance face. For example, you saw this on Ethereum a lot with various lending protocols, various dexes who have governance by token holders who vote. Those token holders end up having some amount of power over where the revenue from the protocol is streamed, as well as over which pools are prioritized, over which lending pairs get various parameters that can be advantageous to them. So it's certainly a possibility. I view it more as a quirk of governance at large and not this specific implementation of governance. But we are thinking of some approaches that we might use down the line to try to mitigate some of these effects. One is that we're thinking about creating voting vaults. And the idea here is that the Atom community should be voting on the Atom validator set, and the Juno community should be voting on the Juno validator set, and so forth. So when all Stride token holders vote across all the validator sets, it's possible that there could be a conflict of interest, though this is true with any form of governance. The approach we're considering implementing down the line is to segment the Stride token holders by which underlying token they hold. So users who hold Stride and Atom and bond those, put them up, lock them for a certain amount of time, can vote for that zone validator set. And similarly with Juno, and especially the smaller chains where they might not be as well represented, this will be important once they come online.
While you were talking, I'm curiously thinking about crazy ideas like future vote selling. I'm not talking about liquid staking right now. I'm just thinking about the amount of things I think in a blockchain, the players in tokenomics, the ever increasing possibilities of what the DeFi Lego created for the digital economics. I think is so diverse already, and it keeps on growing, growing, growing. Like yesterday, I was thinking about. I think somebody on Twitter asked, "What kind of chains would you like to see connected next IBC?" And I was thinking, I would love to see something stupid and crazy like futures on decentralized land or something like that you could trade. And now that I'm thinking about it, like, wow, I mean, it's going to be crazy. Like in some years to come, like now that you talk about vaults, for example, with Stride, and then one blockchain selling their votes right into another. It's like it's crazy. I think we're never going to be able to upkeep with everything that's going on. What do you think, by the way, generally, of how the general landscape of DeFi and tokenomics has evolved over the past 2-3 years? I mean, obviously you've launched your own projects with liquid staking, which is an example of you participating in it. But what's your thought in generally? Are we doing good? Are we improving?
It's a great question. And futures for decentralized sound insane. I don't know if it's a real project or something you made up.
No, it's not. It's not. I wrote it. It's an answer to Crypto City on Twitter, I think yesterday or 2 days ago. It's still there.
That's great. That's great. Yeah. So we're obviously big fans of Cosmos. The appchain vision resonates. Have you ever read Hasib from Dragonfly wrote this post on blockchains as cities, I think last year.
I view blockchain as cities. I think I know what you're talking about. I viewed it exactly like that. So yeah, I know what you're talking about though.
Yeah, it's a great think piece, and it resonates well with me. And I think Cosmos has been a bit held back by both lack of a centralized pioneer figure who can market for the ecosystem, and frankly, technology that's ahead of its time. For example, ETH and a number of other ecosystems have had bridges for a long time, but they opted to go for multi-sig bridges. It works and it enables a whole host of DeFi applications, but it's not the long-term sustainable model. Cosmos Weighted has IBC and now has bridging technology. As of a week ago, the first blockchain launched with Interchain accounts, technology that is on no other bridge. The ability to invoke a message server or a smart contract on a foreign chain from your chain and control an account remotely, or to read data securely, validated by the validator set on each chain in a way that's proven with proof that's passed back in the packet. This doesn't exist anywhere. You hear of companies like Layer Zero raising insane valuation rounds to do something that's, in my opinion, not quite as robust even as IBC. So I really think IBC here is the future. In terms of tokenomics and the way that DeFi products have done go to market, in the past, there have been a ton of inflationary reward based DeFi apps. And I think we're starting to move a little bit more towards sustainable business models where real yield and real revenue are acknowledged and rewarded. I think Kujira, for example, on Cosmos is not paying any inflation at all. We took a somewhat similar model with Stride. We're paying pretty low inflation. That's because we have a sustainable business where the tokens that are locked up in the Stride protocol are earning staking yield, and Stride protocol takes a share of that, and it could possibly go back to token holders if they were to vote that in. I think you're really starting to see a shift towards distributed app specific chains that have control over the full layer of the stack, who can talk in very detailed ways and who speak the same language. And that language is becoming more powerful with the introduction of interchain accounts and interchain queries and much more. For example, with ABCI++, there's a ton of new cool features coming in. And tokenomics are starting to shift more towards sustainable business models that you see in Web 2, where real yield, real revenue, and the acknowledgement that treasuries are really just balance sheets is starting to catch on. So I'm really hopeful about the future here. We're moving a little bit away from Ponzinomics and trusted intermediaries to a trustless and sustainable model for DeFi.
I really like that you mentioned sustainable modeling in DeFi because this is actually something I wrote down to talk to you about. But before maybe we get into it or we do mention it, I don't know, like let's say I've already talked about it. I started to talk about it, I guess. I have no idea what's wrong with my linguistics today, man. I'm sorry. I'm confusing every word. It's like I have no clue. Maybe it's the time of the year. So before we get into it, I do want to mention you've worked for Bridgewater, right? Right. So, people, for anybody who doesn't know, that is a huge firm that does huge investment research and whatnot. And you worked as a researcher for them. Am I correct?
Yeah, that's
That is an astonishing achievement, man. That is something that is, I think, you should be really proud of. It's really cool. And I guess as you spend the time in there, you must have seen what you just talked about, what you just mentioned, economics, tokenomics, Ponzinomics. And how do you guys, for example, in Stride, plan to solve the problem of, in my opinion, one of the biggest problems that is every crypto project is facing? And I don't understand why most people just close their eyes on that, but that's the reality. Sustainability. Like, if there is no bread in the basket, you cannot feed anyone. If there is no fish, everybody's still going to stay hungry. So, how do you guys plan to solve that in Stride? Like, where is the money going to come from? How are you going to keep on feeding developers, feeding yourselves, feeding the community and blockchain and so on?
Yeah, it's a great question. Very relevant today. And I can give a little bit of background on the team in a minute, but I'll hit that one first. Thankfully, Stride's problem, the problem we're solving, is very tangible, very clear, and it costs users ton of money every year. The problem is the trade-off between staking and DeFi. And if staking is yielding 10 and DeFi is earning 10, the user can only choose one, and their opportunity cost is 10 per year. 10% of staked assets is a really, really big number. And so by solving that, we charge a very small fee of the staking yield, and that's where the bread comes from. This is kind of the standard fee model that most liquid staking providers have opted to take. For example, Lido charges this. I'm not sure exactly what Marinade charges, but if you run the numbers behind the scenes, what's happening is you give your tokens to the Stride blockchain and they stake them for you. You were previously earning 10% on those stake tokens. Now, 1% of that 10% is going to the Stride protocol. You get back 9, but Stride is auto compounding for you. So the 10 that you previously got is now more like 12. Previously, you had to do that manually through Kepler every day. People talk about compounding every day. And so 12 minus 1% is, depending on the yield, sometimes more than what you're originally earning. And then you can take those tokens and use them in DeFi elsewhere. So you get the 12 minus 1% plus whatever you can earn in DeFi. So because it's such a pressing problem that's being solved by liquid staking, I think there is a pretty sustainable revenue model. It's been proven out by Lido on Ethereum. They have $1 billion treasury. They're earning hundreds of millions of dollars a year. And in just 18 months, the share of staked ETH 2.0 that is staked through Lido is over 30%. We'll see now what happens with the merge, but it's a well-proven business model. So I think this one is sustainable. It's less clear for some protocols in Cosmos that are doing something new. And props to them. It takes a lot of guts to go out and try to create an altogether new DeFi primitive or an altogether new chain with a separate Web3 purpose, but it's less clear that the business model is sustainable there. I look forward to seeing where it goes.
But do you think that fees are the only solution? I'll explain what I mean. There is this typical, how to say, Web 2, or I don't know, let's say real world model, right? Where the way that the tax system works is kind of fees, right? You pay whatever it is. I mean, I'm not going to discuss whether that's theft, taxation, whatever. There is a fee model, right? You pay part of your fees, whether you choose to or not to, again, a different question. And then you have that model repeated in banks, in private companies, in investment funds. And then now we see this model repeated in Ethereum and so on and so forth. Is there anything else apart from fees that blockchains, in your opinion, should embrace as a model that will help them to sustain the treasuries and will help them to build great futures?
Well, one that's quite interesting and somewhat unique to Cosmos in an app chain's ability to capture it is this idea that with an L1 blockchain, the power of the proposer in the block is special. They get to choose which transactions are included. They get to choose the order. There's some power in that ability. And in fact, they can extract some money from that power by either reordering the blocks or choosing which blocks are included and which are excluded. On Ethereum and on more monolithic chains, the apps that sit on top of the blockchain don't have the ability to extract this value. They typically leak that value to the blockchain. And in fact, many smarter folks than I have suggested that the value of the L1 blockchain, like Solana or Ethereum, is essentially the value of the sum power of these proposers. People call this MEV, but maybe better. I think Sunny said this recently. Maybe is be better coined proposer extractable value, because it really comes down to the power of that person. There are tons of other types of extractable value that exist in blockchains, liquidations, arbitrage, but at their core, the blockchains leak this value. And unless you're building an application-specific blockchain where you can tweak the fundamentals at the lower level to capture some of this, you're often leaking it to the token holders of the L1 chain. Now, in Cosmos, I know some teams are working on ways to capture this. And Stride, in fact, I'm not going to reveal any details here, but we plan to do something very similar in the future. That's another way outside of fees that it's actually very specific to blockchains. It's impossible in Web 2, as far as I understand. People make some comparisons to like rent extraction and monopolies in traditional economics, but really it's kind of its own concept, I think.
I think there was a very good comment. I think, was it Thyberg or was it not Thyberg? It was today that I saw it on. I'm not sure who it was from Twitter. It's just what you said about rent extraction. And for everybody who's listening, I would like to make a comment that no, I think it was actually Sencom. Sorry, it was Sencom. When you have to follow the rules set out by somebody, and one thing when you make your own rules and voluntarily choose to follow them. So I think that's like the big decentralized dilemma question that resonates at the back of my head when I hear things like, "Oh, we're gonna have to pay this and this," but you choose to be here. You choose voluntarily to be part of this community, and you have to understand that in order to make it sustainable, you need to share or do this or that, or whatever.
Yeah. It's huge though. The extractable value. I don't know if you saw Skip Protocol put out a leaderboard. The amount of extracted value in the last year on Cosmos is massive.
What was the number? Do you remember?
I don't quite. Let me pull it up actually.
I'm curious. I did see the Ethereum numbers. I don't think I've seen the Cosmos numbers actually.
Yeah, I think it's called a satellite. Skip Protocol satellite. It's massive though.
I'll be curious to know what it is. I'm interesting. Where does it go as well?
All right, here it is. So on Osmosis, a satellite that skipped out money. In the last 30 days, it's $60,000, and the total is almost $7 million.
Wow.
It's a lot of money.
Wow. That is a lot of money. This is just osmosis.
Just Osmosis.
Great. So there we go, folks, you know. By the way, I skipped asking you that, but I might as well now. And that relates to you and to Stride in both, I guess. I did already mention that you worked. Again, I'm mixing up words. I have no clue why. Bridgewater, Stride, obviously now, Bridgewater before. I know you came from Berkeley. I have a couple of questions from that as well. But before that, well, I guess Berkeley and blockchain kind of go together already in my head.
It's the same thing now.
Yes, it's like Berkeley blockchain. Bam, even with the same letter, right? BB. What's your blockchain story, man, Riley? How did you get into blockchain?
We joke that we're trying to Cosmos pill all of Berkeley. I think they're actually teaching a Cosmos course at Berkeley now. Yes, Sonny's from there. We're from there. But I think
Brian, right? I think
the folks from Akash.
Evmos.
Yeah. Sorry, what I meant is Akash from Evmos. the folks from Evmos.
The folks from Akash are kind of old. I mean, I'm sorry, guys, but they come before us. They come before Berkeley, probably. No, I love the guys, and they know I'm joking if they hear it. But no, not Akash. Sorry, that's Gregory. I'm confusing as well. I'm thinking about not Akash. I'm thinking about Agoric, and the folks from Agoric are the guys who build smart contracts and the internet, pretty much. And there's a bunch of crazy folks, but they definitely come before us. But anyway, sorry. Back to your blockchain story, man. We got distracted.
Well, it's all revolves around Berkeley, so I think we're right on topic. So Aiden, one of the co-founders of Stride, and I went to Berkeley together. We were project partners there doing computer science, and we were very aware of blockchain, but we didn't develop in blockchain. I was part of a club there called Machine Learning at Berkeley. I was a little bit more focused on data science ML at that time. But there was a sister club called Blockchain at Berkeley that you're likely aware of. A lot of the Cosmos folks originated from there. And I think the Osmosis team recruits from there very heavily, and they share an office with Blockchain at Berkeley on campus or just off of campus. So anyway, we're highly aware of what was going on there. I worked in undergrad on machine learning in a research lab with a professor who is very involved in crypto and in fact in the Cosmos ecosystem. Dawn Song, who created Oasis Protocol. I worked with her on ML, but I saw some of her crypto stuff and I was always a little bit curious about the econ side of things too. And so after graduating, I followed a different professor from Berkeley to Bridgewater to work in a small machine learning lab there. We were trying to figure out what are the best macro investments and how to build investment models using machine learning. And that's where I met Vishal, the third co-founder. He worked there with me for about a year before leaving to start his own small hedge fund, and aware of crypto there, but eventually ended up on the crypto team at Bridgewater. And that's where I really went down the rabbit hole and started playing around on the side with some development. And at the same time, COVID was happening. So Vishal, Aiden, and I started traveling around the country, living out of Airbnbs, thinking of ideas of what we could build, specifically in Cosmos, because we're really sold on the vision. We had met Tor Bear, at a conference, and he kind of sold us on the appchain vision. So we'll always be lifelong fans of Secret Network because of that. Ultimately, we looked to Ethereum. We saw the success of Lido. We saw that the Cosmos ecosystem did not have a solution to this problem. And the solutions that were coming, we didn't think were quite as safe as they could be. And we decided to go for it and build the thing in a way that we think will be kind of a long-term sustainable solution to liquid staking. The other thing is we're huge fans of DeFi, and our strong thesis is that DeFi has been held back primarily because of the lack of a liquid staking solution. On Ethereum, yields are 5% for staking. On Cosmos, you see Juno, it's like 80%. Why would you ever LP the osmosis pool for Juno if you can earn 80% by staking? It makes no sense. But if you can get both, I think it opens the door for lending markets. You see Umi and Mars building that now. Vaults, Quasar's building some really cool stuff there. All kinds of new technology that previously was just economically unfeasible because of the trade-offs that are being made. But I went on a tangent there. I'm happy to introduce the rest of the team too. They're interesting guys.
Before you do that, I still want to get to the bottom of things. I mean, that is more what you said. There is the practical side of things. And I totally respect that. And I totally love that you're giving that answer, because I think I was speaking with Cole from Orbital Apes the other day. And I love this answer when I asked him about motivation. He said, well, I want to be the best. And I was like, well, that's a great answer, because sometimes that's your motivation. But usually, apart from the practical side, there is something that comes with it. So why are you a fan of DeFi? Why did you join the Blockchain Berkeley Club? What was the original idea? Oh, to skip classes, or to because you enjoyed it, because you liked the idea? What was the interest in that? What clicked?
Frankly, it was at Bridgewater. I was doing quantitative research work, building models for investment, understanding the financial system. But I felt I was at the zoo looking in and watching all the people play and analyzing and trying to make money off the discrepancies and the deviations from the trend and the pattern of linkages that was not manifested in real prices and data, rather than changing the system itself. And building DeFi is really the only way that we as 25-year-olds have the opportunity to make an impact there. You can't go create a bank as a 25-year-old. You can create an investment company, but you'll be small and it'll take dozens of years until you have enough capital to make a real difference. But DeFi is different because you're really pushing the technology forward. And particularly in Cosmos, there is not much DeFi yet. So there's the opportunity to build something that could make a real change to how the system is working, rather than looking in and playing around the edges.
By the way, it doesn't change at 35 as well. No, but apart from that, I'm wondering what happens at 45. I'm still to find that out. It's still a while ago. By the way, you mentioned Lido Finance, and I don't know if you ever listened. We have an interview with Konstantin, who's the main co-founder of Lido, just a week, I think, before Lido launch. There's a lot of insights of how, in his opinion, business models work and things like that. It's a cool interview if you like what they do. Going back to Stride, though, and you said you were going to introduce the team members and what's their background a little bit. So feel free, man. I would love to hear about them.
Yeah, we have an awesome team, and it's growing, and we're looking to grow it further, actually. I'll give quick intros. Aiden, I mentioned, was a project partner of mine at Berkeley. He did computer science there, went to work at a startup in San Francisco, and then got caught up in the Uniswap, SushiSwap saga and got pulled into DeFi 100%. Quit his job, started doing a number of side projects, and then finally we decided to work together about a year ago on this. He was building some staking infrastructure in Cosmos, actually. Vishal went to UChicago and had always been in the traditional finance world, was doing a lot of hedge fund work. He worked at an early crypto project, was the first engineer at Basis, not Basis Cash, Basis, important distinction back in the day. And then came to work with me at Bridgewater, went to start his own hedge fund, and then ran tech for Quant Fund most recently. And then we have a fourth engineer. All three of us founders are writing code, but we have 4 people writing code total. The fourth is a stellar engineer by the name of Sam. He's actually a childhood friend of mine who lives in Chicago and went to University of Wisconsin. He is a superstar, and he joined us about 2 months ago now. Then we have 3 folks running community. Sam Attal, Summer Collins, and Hazel. They are superstars as well. And then John Galt, who you may know on crypto Twitter, he joined the team and is helping us with all things biz dev, communications. And then we have one last team member is Bharat Talwar, who is currently at Harvard. He's a student, but he's helping with a lot of the biz dev stuff. And we're looking to hire more people. So mostly engineers at this point. We're a little bit short-staffed. It's tough to both lead the project from the founder perspective, but also be writing code every day. So looking to hire some people there.
Where should people contact you if they suddenly hear this out here or anywhere else, or to email or anything else?
Yeah, DM us on Twitter.
DM on Twitter is the best way. Okay, cool. By the way, you mentioned a cool thing at the end of your introduction there. You said that it's a very hard job to run a project and to run code. And we had this discussion with several founders already on previously. I think the biggest one was with Jack Sampolin, actually. We had a big discussion about the product management and like how the difficulties of it and all of that. It hasn't changed. In the past year, the things have not changed, right? For CEOs and founders, and still writing code and managing don't go together. Of course, I'm joking, but like, can you talk a little bit about that? Like, why is it like that? I mean, there's so many questions that derive from that. Like, for example, and there's straight away answers like, why can't you hire somebody else? Well, because you need, first of all, the inflow of money to hire these people. But what are the current difficulties that you encountered when you were launching the project and simultaneously doing several tasks? Of course, is one of them that you mentioned. And let's talk either about that or other difficulties, whatever you like to mention here. I would love to hear.
Yeah, of course. A lot of respect for Jack Sampling. We're doing nothing quite as interesting as they're doing with their relayers and at Strangelove, but they're helping out. They've been great. They actually helped us implement interchain queries on the IBC Go relayer. Andrew from their team spent a ton of time with us working on that. So I don't think our problems are nearly as involved as theirs, but I can touch on it. The short answer is that I think leading a crypto company is the most distracting industry to possibly write code in, because you have Twitter all the time, you have Discord all the time with anyone who's using the product, and everyone's anonymous so they can ask any question freely. You have Telegram all the time, any question all the time freely. And your code is open source, and the community owns, they're all stakeholders. They own the token. So they're very invested, and that energy is incredible, but it also takes a lot of time to be very transparent and communicate clearly and give updates and make sure that all the stakeholders feel accounted for. And something we take a lot of pride in and try to do properly, but it's just a trade-off between that and going heads down on some of the code, especially when the code is complicated. You need a 6 to 8 hour block of uninterrupted focus in order to get something quality across the line. So thank God we have 3 developers leading the team. I don't know how we do it if we just had one, but we've been trading off. And Sam, the fourth developer, has been a godsend. But we'd love to get more on board.
From what you're saying, it sounds like you never expected what you guys did or doing or didn't doing together to go bigger than what you expected. So it sounds like you're kind of in a place of surprise where you think, oh, like we started as a side project and it kind of went into well, now it's not just a working blockchain, but it's a blockchain that's already, I think it probably set some records if you're looking at how the pool got the money and the liquidity, I mean, sorry. And so it seems to be that, but it sounds that you have a lot of ideas and it looks like you guys have a lot of ideas, but was it something you were expecting? Like, that's the question, I guess.
We were expecting for this to be a real project, and we were expecting to be the first to market, and we were expecting to get a lot of traction just because we're solving a very pressing need. But we were also expecting to hire more engineers in the meantime. We did not have time to do that. So that's the part that we weren't able to hit in the middle. Hiring engineers is extremely hard. And that one we underestimated severely, I think. So ideally, we'd have 8 engineers on this today, but unfortunately, it's 4. But that's going to change very quickly.
I guess as well, coming from the background yourself, it's like, a shoemaker, hiring a shoemaker is always harder than not a shoemaker hiring a shoemaker, if you know what I mean. But anyway, I was going to ask you a slightly, well, it's not off topic, but it is a little bit of topic what we just spoke about. As somebody who has such an extended background into not just coding, but researching as well, what is, and crypto being a lot about do your own research and looking at how some people like to say looking for those hidden gems on CoinGecko. What would be your advice? And I don't mean to crypto people, and I mean in general, if anybody is planning to research anything, or maybe not advice, or maybe points that any researcher should look for, like how to understand which sources of information to look at, and doesn't matter what the research is about in general. Is there anything like that that you could point out as a researcher to say, hey guys, this is what you should be doing, this is what you shouldn't be doing?
This is a tough one. I feel underqualified to answer this question.
Come on. No, but it's okay. It's cool. But you can still have a take on it, no?
Yeah, I'll give a take, though I caveat it saying I'm younger than most of your listeners probably, and so I don't presume to know. What has worked well for me has been to start from first principles and understand the very simplest case first and explain it like you're five with examples. So, for example, instead of talking about liquid staking in Cosmos and jumping to buzzwords about validator set, decentralization, and interchain queries, interchain accounts, start with I have 10 Atom. I navigate to the Stride website. I deposit 10 Atom. The Stride website moves those atoms to the Atom blockchain and stakes them. One day later, the rewards compound. Now I have a claim on 1.01 times 10 Atom. So very, very methodical, slow, basic numbers, no jargon. Explain it like you would to your little brother who doesn't know anything more than basic arithmetic, doesn't know what a blockchain is. And if you can do that, and then you can go to the developer docs and play around with the underlying mechanics of the protocol. If you've touched code before, that's ideal. And if you haven't, I still recommend reading the developer docs. Often they're not as technical as you'd think. For example, if you go to the Osmosis core documentation page, there are like 4 or 5 pages that explain the protocol better than anything I've ever seen in the public. If you read through 15 commands you can issue against the Osmosis blockchain, you understand how the GAM module works, how to estimate the price for swapping in and out of pools, how to create a pool, how to add external incentives to a gauge, all these things that really underlie the way that Osmosis is talked about in the public, but they're presented so clearly in those docs in a way that most people, I think, don't read. But if you start there, build with the simple examples, use basic numbers, use simple language, I think you often come away with an understanding that is higher than if you were to approach it through the buzzwords and try to define interchain queries and define interchain accounts and think about the implications of interchain security. Those are very, very important topics, and they naturally emerge once you understand the fundamentals. But if you go straight to them before understanding how a transaction works, then you have a shaky foundation, I think.
So I guess like breaking things down to the very bottom of things, right? That's what you're saying, and going slowly, taking like monotonely.
I'm curious about your approach, actually.
Pretty much what you said, I guess. Considering like I'm not a researcher, but I do like researching things and being so long in crypto. There is, I guess, like a practical mechanic which I'm kind of used to already. When you click on the, first of all, you check the fundamentals of, if we're talking about crypto, of course, you start from reading the white paper. For me, one of the main things is trying, it depends. If I'm looking, let's say, at network, at a blockchain, like an L1 blockchain, then I'm looking that L1 blockchain, whatever, doesn't matter how complicated the white paper is, and doesn't matter if I even understand all the mathematics. I look for the simple IT points, like if a computer has bandwidth, storage, and computation, it will work. If it doesn't, it will not. And sometimes you read like white papers which present to your computer, but they lack in the basic understanding of those kind of things. And that's already like a no-no. Then if I'm looking at application, then I guess I'm more kind of looking at slightly a different thing. So the research, but it definitely goes to what you're saying, breaking down things to the very bottom and trying to slowly look at certain things. Is that in place? Is that in place? Is that in place? And if those things are in place, I guess I will follow it and look at it for some time and then try to touch it with my hands, like you say, try to test it. And yeah, and if that all works, I guess the research is complete for whatever reason the research was done.
Yeah, your point about blockchains as computers and comparing blockchains is makes me think of something we've discussed in the office here with the guys. We think that debates are often a much better forum for understanding how products work than informational settings. So writing an article about your product, not that informational because you can embellish it, you can tweak how you present, and you can put a special name on a feature. But when you get two people in a room and they're using simple language and going back and forth, you very quickly get to the nut of the difference. So yeah, we've seen a few of those in Cosmos. I think Jack Zemplin and Kasamani got on and debated the differences between Cosmos and speedy blockchains. But would love to see more of those in Cosmos. I think, especially as competing projects arise, it's important for people to understand the differences, and it's a really good forum to surface those in a clear way.
I like the ideas that you're throwing at me there. I like that. No, it's true because we have that for the listeners out there. We have another format which is more new, but it's the YouTube format. Before we just used to copy all our podcast episodes on there, the interviews, but now we decided to start a slightly different format. It's like a live stream, and we now focused on validator profiles and project profiles. With the podcast, of course, is very different, but that's a very good format we've been thinking about for a long time. What you're saying, like trying to get people to talk. It's just sometimes it's hard to find the right people that you want to talk, put them together in the same room, considering they're like 1,000 miles apart.
Consider this our offering to go on and talk
Nice.
With either Quicksilver or Lido or anyone who wants to discuss the differences. We'd love to come on.
Man, this is like, we're still live. So now it's on the blockchain. That's it. It's in the thing now. I would love to get you guys together because considering I know like most of the guys from Quicksilver and not most, sorry, but I know most of the guys from Lido, sorry, and I know the guys from Quicksilver, and I've had all three of you on interviews. I would love to put you guys together and have talk out these things. Man, that's actually a very cool thing.
Yeah, we'd love to talk that with Quicksilver in particular. Actually, Vishal is on a panel right now. It just finished kind of a debate on liquid staking with the folks from Lido and the folks from Persistence. But it sounds like the Friends Validator was hosting it. They weren't able to get Quicksilver to join. And then there's also a panel at Cosmoverse with the same people, and Quicksilver wasn't willing or able to join either. So we're really trying to get them on to talk this through. But so if you know them and are able to make that happen, we'd love to talk through the differences.
I will try for sure. I will reach out to the guys for sure because I have contacts of all the guys you mentioned and in contact with the guys you mentioned. So definitely will try. But let's try to kind of wrap it up. And before the wrap up question though, well, no, you know what? I'm gonna put them in one. So the traditional question asked is about motivation and what keeps you going. But I know, by the way, that I seen. I think it's on the Stride website. Something that mentioned parkour videos. I didn't find, but what I did find was like, and I'm pretty sure it's yours. I'm 100% sure. I'm going to ask you that though.
Oh, I'm so worried.
Well, no. It's this robot, the one that goes like, do you know what I'm talking about? You look at me.
The Tensegrity robot.
Yes, the Tensegrity robot. There we go, the Tensegrity robot. So I guess what motivates you is exploring. I mean, if we're talking like that, but then how does the parkour come in all that? Like, what keeps you like keep on going? Like, what things do you do to keep motivated?
For context, I think we put out a thread about the team yesterday, and I I admitted that I have a video on YouTube of myself as a 11-year-old doing parkour with my dog.
I didn't find it, by the way. I didn't.
That's good. It means I hit it well. I promise it's there, but you'll have to dig a little bit deeper. Yeah, no, and then the other video that I think you're referring to is Tensegrity Robot. It's a research lab I was in at Berkeley. We did robotics research, and we were trying to figure out how to get soft, malleable robots. And most robots are like hard shells. The malleable robots are rods and strings, and they pull in various ways, and the robot's rolling. It's a video of that robot rolling. But to your question, I think you hit it on the nose. I love exploring new technological concepts. And more recently, in the last 5 years, concepts at the intersection of economics and technology, which I got a healthy dose of economics at Bridgewater, but I felt that the tech side of things was a bit lacking. So coming into DeFi, it's really a perfect balance of the two, where you get to think about governance and token allocation, investing, and airdrops and economics of protocol design. But you're also doing some pretty hardcore engineering with interchain packet transmission and acknowledgements, and some of these hard problems that haven't really been cracked yet. Thank you for ousting me as a parkour enthusiast. I'm glad you didn't find the video.
I will. Thank you for this answer. I like when people try to explore answers, and the word exploration comes again here, but from different perspectives, not just like straight ahead. And thank you, of course, for joining. Thank you, of course, for the great idea about liquid staking, and we will try to do it. I'm not going to promise, definitely not for the podcast, but for the live version, I think we could try and do something like that. Maybe after Cosmoverse, see if everybody will be up for it, and try to organize a panel for people to talk about that.
That would be a lot of fun.
Is there anything, Riley, I didn't ask? I mean, again, by the way, guys, to point out, Riley's pain is hiring engineers. So, guys, I'm going to point it out again. Riley, anything else you want to mention?
No, so the team has been heads down for 4 or 5 months. In fact, there's a bed in our office over here. I can turn the camera on, but
unfortunately, it's an audio version.
No,
man.
it's not.
But you can, yeah, man, yeah. But we do like promo things. So if you do show me the camera,
I don't think you want to see it, but I'll send you a picture for you, not for the wider audience. But to go back to your question, we've been heads down, and we know some of the Cosmos community from interactions with teams that we're collaborating with and teams that we know from the Cosmos Berkeley community, but we haven't met everyone. So we are incredibly excited to go to Cosmoverse and get to meet the broader community. And so come say hi. We're giving a talk. We have a booth. We're on some of the panels, but we're going to be wearing very bright pink shirts. I'll show you actually. Give me 2 seconds. I'll grab a
nice. Show me. And for everybody who can't see, of course, it's a pink striped shirt. Nice.
It really does stand out. So you'll see us there. And that's it. Yeah, I'm mostly looking to hire engineers, scale up, and meet everyone at Cosmoverse. I'm really excited to meet you as well in person.
We are not going to be at Cosmoverse physically, but for everybody who's at Cosmoverse, and I'm pretty sure this episode will come out before Cosmoverse still. For everybody who's at Cosmoverse, please remember us when you have a drink, because we are the main sponsor of the after party. So you will see those hints. I'm pretty sure that what we are doing, you will see hints that it is us who's sponsoring the after party. They will not be too annoying, I promise. But yeah, we will be there in spirit.
Oh man, we'll pour out a drink for you.
Okay, Riley, thanks, man, and looking forward to the panel. Thank you.
Thanks so much.